When price momentum strikes a sudden, violent reversal, it often leaves market participants trapped in positions that looked like guaranteed winners just seconds prior. This creates a core paradox. Technical breakouts often fail specifically because institutional algorithms use them to identify and hunt clusters of retail liquidity. These apparent surges in price serve as engineered mechanisms, functioning to absorb passive orders and clear the path for a larger move in the opposite direction. Executing safely in this environment requires a bridge between high-level institutional order flow and low-level precision entry logic. The DRW algorithmic execution system provides a framework for this alignment, using a dual-timeframe matrix to verify macro intent before committing to a trade. By utilizing structured mean reversion, the system removes the need to guess where a trend might end. Navigating these markets effectively means looking past traditional chart patterns to recognize the underlying mechanics of liquidity traps. Market movement follows a rotating cycle of 3 distinct mathematical phases. This chart maps those 3 zones, providing a visual guide to the current rotational environment. Consolidation, often called the squeeze, appears as a tight horizontal corridor where institutions quietly build large positions. When algorithms fan out the moving averages to drive price toward a new target, the market enters the expansion phase. Finally, distribution marks the point of trend exhaustion, where the initial move begins to lose its structural integrity. During this phase, price action is designed to lure participants into buying at the absolute highs or selling at the lows, just before the trend breaks. Trade execution depends entirely on identifying these macro regimes. Without this context, an entry is likely to collide with institutional flow. At the edges of a distribution phase, a specific structural anomaly typically appears. Setup number 1 is the sweep. Notice how the price wick pierces the 30-minute deep ceiling, creating the appearance of a fresh breakout. This move clears the order board by triggering buy stops and absorbing the sell orders of those trying to fade the move. Entering the market during this sweep places a trader directly inside the liquidity trap. Confirmation of the trap requires the second phase, displacement. To prove the move was a trap, price must aggressively drop away from that initial ceiling wick, showing a clear shift in momentum. This displacement validates that the ceiling held. Entering here is premature, as the system requires a secondary test. By waiting for this displacement to fully materialize, an operator successfully avoids the chaotic volatility of the initial liquidity grab. Once displacement is established, the focus shifts to setup number 3, the reload. We look for price to drift back upward on low volume, slowly returning toward the area of the initial drop. Price drifts into the defense core cloud, making contact with the 13 EMA reaction line. The trigger occurs when a candlestick wicks into that 13 EMA, but produces a solid body closing firmly below the line. This specific price action is the failed close. This indicates that algorithms are actively defending their entry averages, preventing price from regaining the previous level. A critical requirement for this setup is that the higher timeframe candle must reach a complete close to confirm the failure. If the candle body closes solid above the EMA threshold, the trade is invalidated. The sweep has cleared retail participants. Displacement confirmed the institutional intent. The failed close provides final alignment. Waiting for that higher timeframe candle to print ensures the entry is backed by mathematical evidence rather than a reaction to price movement. The lifespan of a trade is dictated by the timeframe hierarchy chosen for the execution. This hierarchy anchors a higher timeframe structure to a lower timeframe execution chart. The intraday scalp uses a 15-minute anchor with a 3-minute execution wheel. This specific pairing aggressively targets fast-moving price action and intense momentum bursts, typically lasting anywhere between 15 minutes and 3 hours per trading session. The intraday macro swing anchors to the 1-hour chart and executes on the 5-minute chart. This captures shifts in the daily structure, with trades held for an entire session or a full day. Finally, the position swing play uses a 4-hour anchor and a 15-minute execution chart. This model tracks multi-day or weekly moves in the market structure. Matching the correct timeframes sets the mathematical limits for how long a trade should be held and what the expected profit targets should be. Systemic mean reversion functions as a highly structured gravitational pull. relentlessly dragging an overextended market back towards the system's core baseline averages. Overextensions during a sweep create a thermodynamic vacuum, pulling price back towards its mean. The depth of that pull depends on the chosen timeframe pairing. In an intraday scalp, price is magnetically pulled towards the localized 21 baseline. A macro swing targets a much deeper structural barrier, the 55 EMA macro shield, which offers wider profit margins as the reversion grinds out over several sessions. These pairings dictate the exact target of the vacuum and the duration required for the trade to reach its conclusion. These components combine into a single operational workflow. The process moves from the initial squeeze and sweep to the displacement, the reload, and the failed close at the 13 EMA, triggering the snapback towards the 55 EMA target. Linking macro phases with specific mitigations allows execution based on logic rather than emotion. Because the system identifies quantifiable vacuums in price, targets are predefined by the timeframe scale. While these technical markers reveal the structure, the final outcome depends on the operator. Maintaining strict adherence to these rules provides the consistency required to navigate algorithmic environments. By requiring the higher timeframe candle to close before validating a trap, the operator extracts yield through mathematical probability rather than market speculation.